Imagine waking up to see the stock market down 40%, wiping out 5 years of gains overnight. Sounds like a nightmare, right? Well, that's exactly the kind of scenario Bank of America is warning about. They believe what we're seeing right now, even after a 20% dip, could be just the tip of the iceberg. In today's video, we're diving into a serious alert that could change the way you invest forever. If you think the worst is behind us, you might want to think again. Back in mid-February, Bank of America dropped a bombshell. They predicted the US stock market could plunge as much as 40%. And here's the kicker. They issued this warning when the S&P 500 was still flying high above the 6,000 mark. Fast forward to today, and we've already seen the index drop around 20%, largely due to the impact of new tariffs introduced by Donald Trump. But according to Bank of America, that's just phase one. The real danger, they say, hasn't even hit yet. They're pointing to deeper structural problems in the market, ones that look eerily similar to the Nifty 50 crash of the 1960s and the dot-com bubble of the early 2000s. What's their biggest red flag? Market concentration. A few massive companies are making up a huge chunk of the entire US stock market. Just take a look at the S&P 500. Over 26% of it is made up by just 5 companies. That's a record high not seen in 75 years. If this reminds you of past bubbles, you're not alone. In the 60s, the so-called Nifty 50, 50 large-cap can't-lose companies, dominated the market. That didn't end well. The dot-com era? Same thing. A wave of hyped-up internet stocks led to one of the biggest market crashes in history. Right now, the US market is even more top-heavy, mainly due to the Magnificent Seven, big names like Apple, Microsoft, and Nvidia, ballooning in value. So, what's causing this massive imbalance? One big factor is passive investing. More than 54% of the market is now controlled by index funds and ETFs. These funds don't care about company fundamentals. They simply buy stocks based on their size in the index. The bigger the company, the more it gets bought. It's like a loop. A company grows, it gets more weight, so more money flows into it, making it grow even more. While this system has made investing easier, it's also created a huge risk. If investors start pulling their money out, let's say because of a recession or the collapse of the AI hype, those same index funds are forced to sell. And because the biggest companies hold the most weight, they're the ones that get dumped first. This creates a liquidity crisis. If everyone's selling and no one's buying, prices can collapse fast. The AI sector is also playing a huge role here. Tech, communication, and consumer discretionary stocks now make up over half of the S&P 500's market cap. Bank of America warns that if these AI-fueled stocks fall 50%, the entire S&P could lose 40% of its value, wiping out gains going all the way back to 2020. Think about that. Years of growth gone in a flash. Now, to be fair, there are some key differences between today and past bubbles. The Magnificent Seven actually have solid fundamentals, strong cash reserves, consistent profits, and in many cases, relatively reasonable price-to-earnings ratios compared to dot-com era companies. In fact, when you compare stock prices to earnings per share, EPS, they've actually moved more or less in sync. That's a good sign. In past bubbles, prices soared while profits didn't, a sure recipe for disaster. Plus, market concentration isn't a new phenomenon. It happens in cycles. In the 1800s, finance and real estate were dominant. Later, it was railroads, then energy and materials. Now it's tech's turn. But just because it's a pattern doesn't mean we shouldn't be cautious. So, what can investors do if we're heading toward a major market correction? Bank of America suggests 3 strategies. Watch the equal weight index. Keep an eye on how the equal-weighted S&P 500 performs compared to the traditional cap-weighted version. Historically, when the cap-weighted index dominates for a few years, a reversal tends to follow. We might be nearing that turning point now. Avoid overexposure to the Big Seven. Consider ETFs that don't overweight the tech giants. For example, the Invesco S&P 100 Equal Weight ETF, ticker EQWL, gives you exposure to the same companies, but without letting a few names dominate your portfolio. Diversify, diversify, diversify. This one's obvious, but crucial. Spreading your investments across sectors and asset classes helps protect you if the tech-heavy stocks take a nosedive. Yes, innovation is driving markets forward. AI is real. But history has shown us time and again, every boom eventually faces a bust. The key isn't trying to predict exactly when it'll happen, but being prepared for when it does. Here at BizNance Hub, we'll keep breaking down these trends so you can make smarter moves with your money. If you found this video helpful, make sure to like, subscribe, and hit that bell icon so you don't miss the next big insight.